far as the benchmarks go. All right, Jubilant Foods, moving on to that counter, and it has posted that set of third quarter numbers. The total income has come in at 633 crores, while profits were 31 crores, and it has been a little subdued on the operating as well as the bottom line. To discuss the quarter gone by, joining me now is Ajay Kaul, CEO at JubilantFoodWorks. Thank you for joining us on the show, sir. Let's start off with, first of all, how the quarter has been. It has been a little subdued on the profitability front. So if you could start off with that and the highlights of the quarter.
I think the quarter for us as a company went off reasonably well. I could look at it from 3-4 angles. Given the state of the market, which is, QSR or food service market in general, or extending it a bit outside of that into the FMCG space, has been, not too good. You have the results in front of you of some of the formidable players, so you know the whole story. Given all that, I think opening 40 new restaurants, growing at a system level at around 14%, at a same-store basis at around 2%. I think, given all this, we believe is a good performance. However, given what Jubilant FoodWorks has been delivering over the last so many years, it doesn't satisfy us because we believe that we can probably do that much more. And given the kind of investments we have been making for, building a company for medium to long term, investment in our factories, investment in building new stores, into what we invest on technology, people, and so on. We want these numbers to be far higher than, what we had delivered. As far as profitability is concerned, I think despite, the tough conditions, the commodity price falls, and as a result, what happens on our food inflation index and so on, I think we have done pretty well, but it has got compensated a bit by personal expenses and a bit with rental. Let's start talking about personal expenses in particular. There is a one-off adjustment item in this quarter, and if you were to back that out, this is basically led by the bonus act, where 110 basis points impact has come from retrospectively led, impacts because of the bonus act. If you were to back that out, I think our profitability numbers are fairly good. We have been able to, kind of maintain it if you were comparing us to exactly a quarter back. So I would not be worried about, costs going forward and how we manage them. But this quarter has still yielded reasonably good results, even from an EBITDA and PAT perspective.
Fair enough, sir. Let's move on to the same-store sales growth then. I mean, you are in a phase where you're expanding Dunkin', of course. That's a newer entry. Given the fact that you are expecting a slower momentum in sales from the same stores, plus the fact that the continued pace of restaurant expansions will go on, do you see the same-store sales growth from Domino's as well as the existing ones from Dunkin' being a little subdued going ahead for a few quarters?
See, we do not want to make any future guidance numbers for same-store growth. We did say a couple of quarters back that we do believe that in 4-5 quarters we should be able to deliver a high single-digit same-store growth number. But because the market has continued to be protractedly, not delivered exchange in consumer sentiment, we do not want to make any guidance or any kind of statement on same-store growth, while looking forward. However, as far as, opening of new stores is concerned, we do believe this year for Domino's Pizza, we should be able to deliver around 150 new stores. And for Dunkin' Donuts, around 20 to 22 new stores for the full financial year. And as far as going forward is concerned, numbers, which are kind of in the same ballpark for both, should be something which we can deliver. As far as, full potential of Domino's, something which gets discussed often is concerned, we believe there is potential to open 700-800 Domino's stores in India still over the next so many years. And we are building all our infrastructure to kind of support that, whether it's in terms of new commissaries. We have today 9 such factories. We had commissioned 3 last year. And this year, as we speak, we are building one mammoth facility in Greater Noida. Similarly, as I was talking about investment on technology, 36-37% of our total revenue, today out of the delivery sales actually comes through the online medium, which is through the internet. And 38% of that comes through the mobile. So mobile first as a strategy, investment in that, creating the right kind of platforms is all that investments which we are making for building a company for future.
So in terms of expansion, as you said, you're looking at another 150 outlets for Domino's and 20 to 22 for Dunkin'. Given that, of course, your expenses, employee costs, rental, marketing and advertising is also likely to go up. So do you see the overall margins remaining subdued for a bit unless and until this expansion comes completely on stream? As also, as you were saying, the move towards greater online delivery booking as far as that is concerned, the greater shift, 36% as opposed to 27% is what I understand. So that is also seeing traction. A brief word on both these aspects.
See, from the external environment, there are going to be some inflationary pressures, especially on the personal costs. Like the Bonus Act came like a bolt from the blue, and it had significant impact. Around 110 basis points is the impact because of retrospective effect, and 30 basis points will be quarter on quarter. So these are like things which come, out of the equation, and then they kind of make you kind of go back to the drawing board. But there are also positive impacts which come from lines like, the commodity costs, or call it the food inflation, which is definitely under control, and we are managing it quite well. Now, going forward, I don't want to make any statement on whether our margins will improve or they will go down and so on. All I can say is, and as we are in the midst of our budgeting process, we will firm up some numbers soon. All I would say is that deployment of some intense Six Sigma, initiatives within the company, with strong focus on efficiency and productivity rather than cost cutting, we do believe we will be able to manage our cost lines also very well. And hopefully with a bit of, fillip from an improving consumer sentiment, which we are in the heart of hearts very positive about, although we don't want to kind of stick our neck out and say that right now. I think, situation will improve going forward. See, the key point here is, and I want to kind of reiterate it again, our belief in the consumption story, our belief in the middle of the pyramid, our belief in the hinterland story of India, the tier 2, tier 3 cities, we are today present in nearly 230, 240 cities in India, is still firmly intact. It's only a question of a few quarters here or there that the numbers are not stacking up. But as soon as that were to happen, we want to be ready more than any other player in the market, and we want to hit the road running as and when that upswing, or call it the turnaround, starts happening.
All right. We leave it at that, Mr. Gaur. Thank you so much for joining us and shedding details about Domino's as well as Dunkin' and a detailed explanation of the earnings numbers as well. All right. Moving on, as far as the markets are concerned.